U.S. equities are showing a lot of grit lately. Even when geopolitical headlines trigger morning sell-offs, buyers keep stepping in to drive intraday recoveries. According to the Compound, this resilience is being tested by oil shocks and inflation as we head into a critical technical battle at the 675 pivot level. Wednesday's data provides a temporary baseline for inflation, with February CPI and core numbers landing exactly in line with expectations. However, physical risks are mounting. Bella reports that 3 more cargo ships were attacked near the Strait of Hormuz overnight, bringing the total to over 10 vessels. Despite the headlines, the market is maintaining a level of persistent resilience. Trade Brigade notes that buyers are successfully defending the SPY's 675 level, which remains the primary technical pivot as the session resolves these competing forces. Wednesday's data provides a temporary baseline for inflation. According to Bella and Heresy Financial, February CPI rose 2.4% year-over-year, while core inflation hit 2.5%, both figures matching analyst expectations. However, with physical risks mounting, the focus is shifting to the technical tape. Trade Brigade is watching the S&P 500 at the 675 level. This is our session pivot, and buyers have successfully defended it, despite repeated intraday attempts by sellers to break lower. While emergency releases provide some cushion, physical risks in the Strait of Hormuz are still mounting. Bella reports that with 3 more ships attacked overnight, the total has now exceeded 10 vessels. This persistent supply friction is why the channel expects oil to test the $100 to $110 range, even if a move toward $120 remains unlikely for now. The energy spike is putting the Fed's pivot at risk. The Compound argues that if oil prices stay elevated, near-term rate cuts are off the table. This has already pushed recession odds to 35%. Looking ahead, the channel sees a potential 50-50 chance by late next year if policy errors persist. The technical tape is approaching a decisive moment. To confirm a durable rally, we are looking for a follow-through day, which historically occurs between day 4 and 7 of a recovery attempt. The specific trigger is a Nasdaq gain of roughly 1.5% on higher volume this Thursday. For now, the S&P 500 is holding the 675 level. Market internals are not currently showing the aggressive bearish divergence that typically precedes a major breakdown. Trade Brigade notes that the technical tape has reached a decisive line in the sand. The S&P 500 is holding the 675 level, which is serving as the primary pivot for the current session. While the daily downtrend is still in effect, sellers have failed to generate meaningful follow-through after testing these lows. Buyers are successfully defending against intraday pressure, and since market internals aren't showing aggressive bearish divergence, the odds of a bounce are improving. However, a durable rally still requires a follow-through day, like a 1.5% gain on the Nasdaq this Thursday. Investors are beginning to hunt for value in quality stocks as macro pressure forces valuations lower. Joseph Carlson points to several names hitting attractive levels, including FICO, which has dropped 26% this year and sits almost 50% off its peak. Microsoft has also pulled back 14% as the market weighs the high cost of AI infrastructure against long-term returns. S&P Global is taking a different approach to its own 16% decline, nearly doubling its share buyback plans. Despite the recent energy shock, some analysts see a path forward. The channel highlights Tom Lee's forecast for the S&P to reach 7,300 by the end of March, noting that the market is handling higher oil prices better than many expected. Joseph Carlson points out that several quality compounders are seeing significant compression. FICO has dropped 26% year-to-date, putting it nearly 50% off its highs. Microsoft has also pulled back 14% as the market gauges heavy AI spending against long-term returns. In response to its own 16% decline, SP Global is nearly doubling its share buyback plans. Tom Lee is targeting 7,300 for the S&P 500 by the end of March. He notes that the market is currently handling higher oil prices better than many expected, although he admits bear market risks could still resurface later in the year. The watch list for the next 48 hours also highlights specific sector risks to track alongside our primary technical pivots. In the income space, we're monitoring BDCs, where falling rates may pressure floating rate loan income and threaten dividend stability. We're also tracking Vital Farms. With the stock considered fully priced, Any normalization in egg prices or operational impacts from avian influenza represents significant downside risks. The second key level is oil at $100. Multiple sources flag this as the pivot point that could derail the Federal Reserve's current easing cycle. Finally, we're monitoring dividend stability in the BDC sector as shifting rates begin to pressure those floating rate income streams. Market resilience is being tested by energy volatility and fiscal debt. We're watching these watchlist levels, specifically S&P 675 and $100 oil, as we head into Thursday's technical decision day. You can find the full list of sources in the description. Subscribe for high-signal updates on the 2026 market battle.